We are meeting again. So today is our fourth session during the lockdown period. So if you recall, last week we have covered most of the topics which connects to audit planning. So I have given you overall introduction about this paper. So I am not going to give you, assessment of whether auditing is difficult, how to tackle this. So I won't, if any one of you are watching this video first, so don't go to this. So please make sure that you cover from the beginning. So we have named this session from session 1, 2, 3, 4. Especially during session 1, I emphasize the fact that auditing is not a difficult paper. So if you know the art of learning some of the concepts in very simple way and then practically connecting them to case studies, right? So all of that I have covered in relation to audit planning. So today in our session, actually if you look at the screen, you can see in terms of this webinar series, within a limited number of sessions, we are trying to cover examinable topics as much as possible. So in my session 1 and 2, the topics that were covered in relation to audit planning, actually I was able to connect it to 2 case studies in the pilot paper. And also if you look at in addition to now 3 things I emphasize if you want to pass the exam. One is knowledge. So you have to be brilliant in terms of concept, right? So this is why this webinar series essentially explain to you some of the concepts which are critical in auditing. If I connect this to my session 1, one of the main concept that we learn, assertion, and how assertion links to audit risk model, right, where we identified inherent risk, control risk as risk of misstatement, and then I connected this to auditing standard number 315, the risk identification process, and then how auditor can influence audit risk model through detection risk, that is auditing standard number 330, in terms of auditor's testing strategy, that is test of control and substantive procedures, which we call FAP, further audit procedures, right? And then risk assessment procedures, the procedures which auditor use to understand the entity and identify this risk component are called risk assessment procedures. Together, risk assessment and further audit procedure is called audit plan, right? And beyond the audit plan, I also covered you the concept of OS, or the overall audit strategy. So when it comes to overall audit strategy, the whole idea is the macro perspective. So which means there we look at direction of the audit, right, and scoping of the audit, whether what is the type of industry, the reporting framework, currency, right, and timing, interim versus final audit, the resource allocation. Now during these 2 minutes, what I just put down here, some of the concepts that we discussed in the previous lecture, right? How do you understand inherent risk in terms of assertion? How do you understand control risk in terms of control failure? It can be a design failure or implementation failure or failure in terms of operating, right? So this is how you relate concepts, and you can also see how concepts connect to auditing standards. So I am just telling you, this is what we were learning, we have been discussing, right, in terms of knowledge. The other thing is, knowledge is useless if you cannot apply to a scenario. That's where application matters. The last thing that really matters, right, you can be brilliant practically as an auditor, you are knowledgeable, you handle, scenarios, you help clients and so on, you are doing a lot of work, but when it comes to exam, what matters is writing. The art of writing really matters. So therefore, when it comes to this webinar series, I give a lot of emphasis on writing, right. So that's just an emphasis of what's our focus, right. And at the end of today's, probably we'll be doing few more sessions today, right, and I'm sure at the end of the day, together with previous 3 sessions that were covered, we will be able to probably cover more than 50% of the syllabus, right? It may be about 50 to 60%, and there are some other sessions, I am sure those will be covered later. So, to start today's discussion, as you see, our topic is materiality and group audit planning. So, let me to connect this to the process. If you remember my lecture 1, right, where I explained to you the story of auditing. So, I will start with that. So, like the usual sessions, usual advice that I gave you before you start. So, imagine today, so it is actually a bit of difficult when we talk like this, you know, in the usual setup we have a lot of students to interact. Now, this webinar series, as you know, it is about speaking in an empty room to a camera, right, but we have to, I am sure when it reaches you, you are going to make it more interactive, because I explained to you this is going to be the future. In terms of learning, you can see how you save your time. Wherever you are at home, very easily, you are going to cover a lot of areas in terms of knowledge, writing, pilot papers, to all of that. So, therefore, please get the maximum benefit. So, prerequisite when you are listening this video. So, I want you to make sure you have a blank piece of paper or take the same booklet that you used earlier, and please make a note of key things that we are discussing today as key learnings. As we go through in this presentation, you will see some slides as session break, and it will detail out key concepts that we have covered, right. So, therefore, I want you to make sure that you write notes. You can pause this video at any time and then see whether you understand it. Still, I haven't started today's session properly. I just gave you an introduction and connected it to where we stopped, and then we can start again. This is my start. The story of auditing, if you recall, the story is this. When I say story, the story has to have end result, which means what is the end result of auditing? So, main thing is to conclude whether financial statements are free of material misstatements. So, today our whole topic again connects to this in big way. I will tell you why. So, after this conclusion, audit is supposed to give give a report to shareholder. This is where auditors report. So, auditing standard number 700 deals with auditor's report, right. So, this is the end purpose of auditing, and again, if you look at how to achieve this objective, number 1, auditor has to ensure that ethical requirements are followed, right, ethics. So, this I have covered in my session 1, just as an overview I am presenting this to you, meaning if auditor is not independent, that report is useless. So, independence is one of the important things. Then if you want to give an opinion, the next bigger thing is to make sure every relevant auditing standards are to be followed, and when auditing standards are followed, it provides sufficient appropriate evidence which provide the basis for the opinion. So, in terms of evidence gathering process, I explained to you, right, this is divided into RAP, risk assessment procedures, where auditor will identify where the RMM, which is risk of material misstatement, and in terms of FAP, auditor will figure out what is the suitable testing strategy, combination of test of control or substantive procedures to cover PAC. You remember PAC cover? That is assertion, right, the presentation, accuracy, cutoff, completeness, occurrence, valuation, existence, right, and obligation. Now, this is evidence gathering process, and today in my sessions there is lot of emphasis. Number 1, what we are going to talk now this says risk of material misstatement. So, we need to discuss the concept of materiality before we proceed further. Once we understand that, we will come to audit reporting, right. So, that is reporting related standards. So, let us start then with materiality session. So, now first concept that you will learn today, the concept of materiality. right? So like I advise you, in your piece of paper or a book, you can write down materiality and what does it mean to you when something is material. What does it mean? So remember, materiality definition is more than auditing, it comes from financial reporting. When we say something is material, the whole idea is, right, the definition of materiality. Information is material if it's omission. So omission means information is not included in the annual report, right? For example, there is a litigation which is omitted, right? So keyword omission, right, or misstatement. Now what is a misstatement is another discussion that we have to have. So if there is omission or misstatement, imagine we are talking about a company, right? So there is a company ABC Limited and this is a manufacturing company and the company has stock amounting to 50 million, and we know that auditor has discovered that this 50 million includes 10 million inventories which are not moving, non-moving inventory, which means this company is, let's say this is 20% of the profit. So 20% of the profit is wrong. Now that is a misstatement which is going to affect users' economic decisions. That's the key word, economic decisions. Therefore, when we discuss materiality, remember omission or misstatement which will affect economic decision of user, that's called materiality. So in the interest of time, so I want to make sure this strategy of less more, within a limited time you are going to learn the maximum. That's our strategy. So therefore, having understood the concept of materiality, I am asking you again what it is. Omission, the word omission or a misstatement which will affect economic decisions. Now look at, so let's put this in a conceptualization, right? Metaphor. Metaphor is, you know, we are explaining a concept using some real world phenomena. I don't know how you interpret this, right? But for me, this looks like a filtration process. You have something here, filtered. Then you should ask in auditing, what is this filtration process means? We are starting big, right? You can draw this with me so that you understand what it is, right? We are looking, if you look at this as information or the say numbers in the financial statement, the smaller the number find, the higher the number that is going to be misstated, that's going to have a major impact. So therefore, so let me to put this properly. So the filtration process, right? There is something here, you can probably say that significance, level of significance drops and the level of significance increase. Now when we say significant, remember materiality means economic decisions, two things matters, right? One is, in my previous example, 50 million stocks, 10 million is misstated, that is the size, right? So when it comes to materiality, size matter. Now we are talking about a misstatement. Remember our context in this discussion is to talk about misstatement. So whenever there is a misstatement, size matter, right? 10 million, which is 20% of the profit, it is material. The other thing that matters is nature. Now in my example here it is 10 million. This is another example which is 100,000, right? But this 100,000 relates to a disclosure which is required, say in a bank. This is a central bank requirement, some disclosure which is missing. The value may be 100,000, right? Or the 100,000 relates to a new policy change, right? If you see something irrespective of the value, you will see the nature of the circumstances that relates to that error or a misstatement is significant by nature. So when we talk about materiality, we talk about both. Information can be material by size and nature. Now let us start the filtration process. I am connecting this to audit planning. Now auditor has to quantify in some form, this is the amount, because finally if you put it in simple word, when you are doing audit, there is a balance sheet, P&L, and then let us say there are debtors, there are about this company has 1500 debtors. Are you going to test all 1500 debtors? Or to have a threshold, no, I am interested about debtors more than 100,000. So who gave you 100,000 figure? And after the audit you will see my debtors are overstated by 2 million. I am going to change my opinion. So what is 2 million? That's the end result. So in terms of, now after another 10 minutes time you will learn a lot of new words, right? Now the first level of filtration is this, and remember this is auditing, audit planning, right? So this is at the time of overall audit strategy, right? Overall audit strategy. Remember this I covered. If you don't know this, please go back and watch video 1. OS, overall audit strategy, right? So if somebody asks overall audit strategy in few words, that is the biggest strategy for the audit. What is the audit approach? Are you going to do substantive, test of control? What is the nature of the company that you are auditing? How many branches, etc. right? And what is your maturity level? Therefore, at overall audit strategy level, auditor has to establish 2 levels of materiality, right? Now this is very sharp learning, right? And you have to carefully understand what I am trying to explain to you. When I say 2 level, what do you mean by that? The next stage of the audit we will talk about. Now if this is overall audit strategy, right, and that I will use another color to write, that materiality level is called overall materiality level, right? Let us say overall materiality level, and that auditor can set up in 2 forms. So I will tell what are those 2, and then if this is overall audit strategy, the other part is audit planning, right? At audit planning stage, and as you know right now, what are the 2 activities under audit planning? Nature, time and extent. Now when we use these 3 words, you have to understand, I am sure you know what nature means, time means, extent means, I have covered that. Risk assessment procedures, right, meaning for the risk assessment where the auditor should look at all the balances, you know, all the items in the accounts, or some based on the risk, and then further audit procedure. So further audit procedure is about testing, you know, when that's test of control, substantive procedures, which balances to test. And here this maturity level we call it PM, right, performance materiality level. So these are very important concepts. Now you heard 2 words, overall maturity level and performance maturity level. Now overall maturity level, one way to set, or like I said, why there are 2 sides, I will explain to you. The first one is called, I am writing now ML for maturity level, please follow this, right, materiality level for financial statement as a whole. So when we say this, right, we can actually use, now as you see, maturity level for the financial statement as a whole. Therefore, we will use some elements of the financial statements. When I say element, right, now we use sometimes this word benchmark, right, okay. If I want to calculate a figure, right, can I use profit before tax? If so, what is the percentage? So, now usually if you look at many audit firms, they have their own percentages, but International Accounting Auditing Standard Board deliberately in their standards and guidelines says we do not give a percentage, right. For example, most of the time if you look at books, it says 5 to 10% of the profit before tax is material, right. Like I said, in auditing standard you will hardly see this type of range of percentage. Of course, somewhere they have emphasized one of this, but it does not give you a formula, because the whole idea is, remember, materiality is a professional judgment. So, profit before tax is one element, and then you can use, let us say company has a loss, then can we calculate percentage of loss? May not be appropriate, because the profit is fluctuating, right. Then we might use revenue as a base, revenue, but remember if it is profit before tax. So, imagine now for the purpose of this example, let us take 100 million is the profit before tax, and I use 5%, and that is 5 million. This is my overall material level, right. But if I use revenue, I should not use 5% for obvious reasons. You know, the profit is the bottom line, revenue is the bigger one, top line. Therefore, the percentage which I use usually 0.5 to 1%, 0.5 to 1%. Now, you have to have some idea, understanding about these percentages. I am going to show after this explanation some notes from your study text, which you will go through today to make sure that this session is fully understood. So, there is profit before tax, if you want to calculate material level, you can use revenue, say 0.5 to 1%, this is 0.5 decimals. And you decide for whatever reason, I will tell you the reason shortly, total asset, to use let us say 1%, 1 to 2% of total asset. If you want to use net asset, say 2 to 5% of the net assets. Likewise, you know, some guidance as to what threshold, what benchmark and threshold that you have to use in materiality calculation. My next question is, practically how are you going to decide whether it is profit, revenue or asset? That is where these criteria matter. So, these are the points. See, in exam questions, this is very important. Now, there is a question, examiner simply asks, right, calculate plan in material level. Now, what are you going to write? Are you going to take 5% of profit or 0.5% of revenue? The answer, before jumping and saying I always use profit, look at these factors, right. Number 1, attention of users. I will explain to you one by one. So, write this one word, attention, right. Number 2, volatility. Number 3, nature of the business, let us say. Number 4, ownership structure. Ownership structure. Now, depending on these factors, you will decide in this company I am going to use profit. Why? Everything in this business, all the performance indicators, the bonuses, right, everything. If you look at management reporting, the most attention, emphasis is given to profit. This company's most of the KPIs are profit driven, right, and volatile. Now, therefore, you may select profit, but whereas some other companies you will select the revenue is the most sensitive item. So, they measure everything, most of the KPIs, the targets in terms of revenue. But for practical auditing, right, if you ask from practitioners, very often the choice is profit, because end of the day everybody's attention is on the profit. What's the bottom line, right? But there are cases where you may not be able to take the profit. One example is this volatility. Now, last year there is, now what do you mean by volatility? Last year there is a loss, this year there is a profit. Or we are talking about, say, this is 2020, right, and 2020 profit is 2019 profit is about 100 million, and now this has become 5 million, this is 5 million, right, or that this is 100 million and this has become a loss. It's really, and if you look at another year, it's fluctuating. So, when it fluctuates, that indicator is not a good indicator, which means instead of profit in that company you may use a revenue. And at the same time you will see there are some companies which are, now you may ask, how about NGO, which is not for profit organization, then there is no profit, there is no revenue, what should we take? But look at again from economic decision perspective, the money which comes to NGO, say donation matters. So you may calculate percentage of donation, say 1%, 0.5% as materiality level, or else the amount of expenditure matters. So then you will use expenditure percentage as a materiality. So if you look at some other business nature, I am going to nature, let us say unit trust. So what is the key thing end of the day? Now unit trust, they invest in instruments and those instruments are valued, and finally the asset value really matters, the net asset values, right, or the total asset value. So some business asset play a bigger role. So therefore when it comes to materiality, so you have to look at what is the most appropriate benchmark. For the exam purpose, remember your first choice, you can use profit, but usually if there is a losses, fluctuations, don't use profit, right, then you may use revenue like this. So I am sure you have some idea about this is one materiality level for the financial statement as a whole. Then what is the other one? Why there is at the time of overall audit strategy, right, so auditor will decide, right, so I will write it in this full space. Now here what is our materiality level? 5 million, because profit before tax is 100 million. But auditing standard requires, in some cases auditor will decide a particular materiality level. Please note the word particular. Materiality level for particular transaction, particular materiality level. I use the word ML, right, so I will use the same color here as well, materiality level for particular. Particular what? There are three things: account balances, classes of transactions or disclosure. Now which means rather than using 5 million for the entire account set, you will decide this is a diversified company and there are some areas which really requires more attention, specific attention. Now here if there is a misstatement beyond 5 million, your audit report may be changed. That is the overall idea when it comes to overall materiality level. Auditor may change the opinion. See, that is the power of materiality. But when it comes to this transaction, this is a particular one. I will give you an example. Now this year there is a diversified company. One of the subsidiary involves in food processing, right, and they have found these are essential foods and produce at a reasonable price, whereas other businesses they are into is more high-end products. This company which involves in food processing, they are making losses, and the company decide to shut this down, the operation. It's going to be a discontinued operation. As you know, there is SLFRS on discontinued operation. Now most of the shareholders don't like this, they oppose this decision. Now therefore in a context like that, the economic decision of users, they are interested to know, right, now what is the loss or profit or any item in this discontinued operation, they are more interested. Therefore auditor may decide to use, see now out of that operation, let us say discontinued operation asset base say about only 10 million. Right. So then auditor may decide to use a very small materiality level like 100,000, because if there is even 100,000 misstatement in this discontinued operation, that matters. So therefore likewise, what are the other sensitive items? So it can be things like EPS, accounting policy, or like I said earlier, regulatory requirements, a central bank reporting, something that affect laws and regulation. So those materiality level auditor can decide a level, right, which is lower than overall materiality level. So that may be a percentage of that balance. Remember, materiality level for particular particular account balance, classes of transaction or disclosure means, in my example, if it is discontinued operation, in that operation profit you will take a percentage, profit or loss. That may be a very smaller figure than 5 million, right. So, what are the guidelines for you to set a specific materiality levels? You can write this down again, very important that you note what this means, right. So, some of the guidelines that are used, one is like I already said, regulatory regulations and laws, regulations. I have to take now. Say laws and regulations, right. If there is account balance which is connecting to regulations, right, or if there is account balance, again we can use the word attention is required, right. Now my example is discontinued operation, right, and in addition key disclosures, there are key sensitive disclosures, right. For example, if there is a problem with earning per share or any such disclosure, this is not a disclosure, but this is a sensitive number. Likewise, you see a litigation, what is the value of a litigation, this company is having a tough time. So, those are called particular materiality level. So, what is our first learning point? At the overall audit strategy level, auditor will decide one materiality level for the financial statement as a whole. That 5 million here, 100 million, 5%, this is 5%, 5 million, any account balance, you know, when auditing, to decide whether it is misstated materially, right, 5 million can be used. But particular materiality level means you are coming to a lower level. This is as a whole. Here you take one area and decide. So, I hope you understood. Now, the second concept that you will learn, right, now what is from overall materiality level to performance materiality level. So, what is this? Now, when it comes to auditing standard, what they say, you have to set up a materiality level which is lower than the overall materiality level, which means lower than 5 million. I decide to cut 20% out of 5 million, which means I am going to take 80%, right. So, I am going to use 80% out of 5 million, right. Let us say now my materiality level is, performance materiality level is, PM is 4 million. Now, one can ask what happened to 1 million, right. What is this 1 million? It is there for two purposes, right. Okay, before explaining in detail, let us understand in very simple language, right. In an audit, the level that will affect the audit opinion is 5 million. Do you understand? That is overall materiality level. In very simple language, when it comes to audit testing, now I am auditing inventory, right. So, when I select sample for testing purpose, when I identify risk, now I am not using 5 million, I am using 4 million as a benchmark. Or if I have a particular materiality level, right, remember again, for this also you can have a performance materiality level. Right, that means out of this 100,000 you will further cut it down to 80%. Now, this level 4 million here, right, is used for the purpose of identifying risk and testing. But my question to you, why there is this 1 million? What does 1 million means? It is used for two purposes. Now, you can assume that 1 million, like actually now for this is I am explaining to you in detail, right. For the exam purpose, examiner will not ask you why there is a gap and what are you supposed to do, but remember, if you want to logically understand this full picture, you must know that. So, 1 million is like a margin of safety for auditor, you know, there is a safety margin. Why? While I use the audit using 4 million. So, this is my final figure, because when it comes to 5 million, I have to decide my opinion is to be changed or not. Therefore, it is careful in auditing, I can't use that my overall level, I am starting with a lower level. Why? Number one, there can be undetected misstatements. You know, while auditing, auditor will find, okay, there are undetected, I will not find all the misstatements, still I can tell, you know, up to 1 million I have a safety margin. So there is no worry, right, but if it is above 1 million, audit is in trouble. One is undetected, the other one is uncorrected, which means, remember again, this is very important. Now during the audit there are very small little misstatements, these may not be corrected, but even if you correct altogether there is still 1 million buffer when audit is using 4 million as a material level. So please write in your book, the first thing that you learn now, right, first thing, how to calculate overall material level at the planning overall strategy stage. It can be as a whole or particular material level. Number 2, when it comes to planning and performing procedures, auditor will use a performance material level. What is the explanation? A level which is lower than OML is called performance material level. The last, this is not over. If you read the standard, this is all in the standard, mostly this part, but this part is not there in this standard but in another standard. Now you cut it down from this and say that this is trivial. Now if you look up the dictionary, what is trivial? Trivial means inconsequential, insignificant, trivial. Now in an audit, say you are auditing a larger company, you find error of 100 rupees, 200 rupees, 500 rupees, 1000 rupees, forget. Now auditor usually establish a level called threshold. Now I see some audit firms, if you ask, they will say, okay, our trivial level is we take OML and 1%, you can have some basis, right. Let us say here we use 10,000 as trivial. What does it mean? Practical auditing. If you are auditing, you find a misstatement of 15,000 in other receivable. So you write it down. This is my list of misstatement. Now different audit firm use different names. This is a list of unadjusted differences. Unadjusted differences, right? So sometimes they say SAD. What is SAD? Are you sad? Summary of aggregated differences. Some audit firms use SUD, summary of unadjusted difference, because these are not adjusted. So there is 15,000 in other receivable, right? There is another 20,000 in say this is called other payable, right. So all these are overstatement, let us say. So you have you can, like that, you have a long list you have to add, but out of this list you will also have stock overstatement which is amounting to 4 million. That is a significant amount, right. Now if you add 4 million all of this and you find that your misstatement is exceeding 5 million, means there is a problem. You must talk to the client and ask them to adjust at least some of these big items. That is why in another auditing standard, if you read, there is a standard called management representation. Auditor has to give a list of uncorrected misstatement and request management to adjust. Otherwise financial statements may not be fairly presented. Now this is what I explained to you, one standard. This is Sri Lanka Auditing Standard 320, and this will be very important because today I am going to do few sessions with you, right. We cannot discuss audit reporting standard properly if you do not know materiality, right. And in the exam this is very useful. There can be 2 questions in the exam. One, you may be asked, and I am sure today also we will go through some question from your pilot paper. There may be MCQ about these things, right. What is performance material level? What is overall material level, what is a particular material level. Second application, in exam question you will be given balance sheet and P&L and you may be asked to propose a materiality level. So look at these guidelines, right. If you see there is no volatility, the attention is on the profit, use 5% of profit and say this is my answer. Say why you are not using revenue. So that is enough for your level, right. The next exam question that you are going to get, that is very big question. Audit report in question, you are supposed to judge whether a misstatement is material. So you use the same example. So with that I am closing the session, first session, when I say our first discussion, materiality. Now we are going to start a big topic, right. As you see, our session today, materiality, session 4 is materiality and group audit planning. So our next topic is group audit planning, and I want you to take, if you are continuously watching this video, take a 1-minute break and prepare, be prepared for a big topic, complex topic. And when you go through your study text, I am sure all these standards if I am not mistaken, study pack chapter, maybe chapter, I can't remember chapter number, but this chapter is audit planning chapter. In audit planning, you will see materiality standard. These are very powerful. If you are learning auditing properly, the first thing you must get right is planning part, because if you understand audit planning, everything else is connected. So in the same planning standard, you can see the group auditing part. Right, now let me to tell the story of group financial reporting now. So please write in your book the topic group financial reporting. I think before I get into group auditing, so I have selected carefully few slides for you. Now, if you understood all my explanation, please follow these slides carefully. Right, number one, I will explain to you this today as a part of audit reporting. Right, why there is a standard in the middle called 450 standard. Now 320 standard is materiality, where we identify a misstatement. Remember, before giving the opinion, the idea of 450 standard is auditor is supposed to evaluate whether uncorrected misstatements are material, both by size and nature. That evaluation standard is called 450 standard. So I will cover actually that as a part of audit reporting. And now these are the key things. If you go through your study pack, you will find this paragraph. When establishing OAS, auditor shall determine materiality level for the financial statement as a whole. In our example, this is what? 100 million profit before tax, 5%, right, 5 million. And another paragraph, if it is required, which means it is optional. Now auditor will leave it out, 5 million is applicable, but in the same company, auditor will say, I am using a different example now, this company has related parties which are suspicious, and some of these related parties have been challenged by tax department. Therefore, while you have 5 million as the main materiality level, you may set a related party materiality level which is 100,000, very low, because the risk is high. Now you can see higher the risk, the lower the materiality level which is used, because you want to audit that more. So therefore, this is called particular materiality level. See the word particular. Now even in my diagram, you see I am doing this very fast, and I do not write the full word on the whiteboard. You would not have seen this word properly. Now read it properly. Particular classes of transaction, account balances and disclosure, that we covered. Third one, PM. Performance materiality level, I said what is the purpose? Risk assessment and further audit procedure, RAP and FAP. Then I also explained to you, this is very important, this is from your study text, because you will wonder from where I got 5%, 5 to 10, do not worry, for the exam purpose, this is very important, say 5%, is actually 5 to 10, you can say profit before tax 5 to 10, that is fine, right. Then you can also say this is very similar, right, gross profit or revenue. This slide is very important for those students, they wonder how to calculate materiality level, especially if you do not have audit firm experience. You have to then visualize, okay, there is some theory, but how it can relates to practical environment, right. So these are for the revenue, and asset 1 to 2%, net asset 2 to 5. So this benchmark. So this slide is from study text, and then this is again important, because you can have as a whole level and a particular level, right, and also you can set a performance materiality level for both, that also I explained to you. Then the other thing I explained to you, if in my example OML was 5 million, performance materiality level was 4 million, because I took 80% cut. Okay, you should ask me a question. Unfortunately, you can't challenge me right, but later you can, let us say in an interactive class you can ask how comes, why did you use 20% cut, because see what I did is out of 5 million I took 80%, No, then you can ask, why didn't you take 70% or 60% or 90%? Now this is, I can give you one powerful answer in auditing, this is professional judgment. But remember, judgment you cannot take out from your pocket. Judgment has to be well conceived, carefully thought, and then applied to the situation. The idea is, if I use 95%, see my cut, I am going to use a very lower cut, meaning say out of 5 million I took 80%, no. Let us say this is one company, say company A. Company B I am going to use, say my cut is going to be say 60% or 70%, the more cut, because I see more risk in this company to audit more, right. That is the whole idea. This cut, haircut depends on the level of risk. So, but in my example, 5 million is OML, overall material level, 4 million is performance material level, 1 million is there for two purposes. One is, I clearly explained to you, there can be immaterial items which are not adjusted, and there can be undetected misstatements. So, in the session what you learn, right, you have learned this concept and application of OML and plan in material level, and now we are going to look at, this is a very important topic, and in advanced auditing, group auditing is a really advanced topic, because as you know, the idea is not a company but a group of companies. So, let me to now tell you the story of group financial reporting. It's interesting. Imagine, I want you to now imagine when you become a chartered accountant one day, right, after about 10 years of experience, you are promoted as a group CFO. And under your purview there are 10 companies, and you are, see, some of these companies are under your group, 3 companies, and some other groups belongs to different companies run by separate board, but you have invested, right. Now some of these are associate companies, yeah, now you have heard these words, right, associate, joint venture, subsidiary. Now some of these associates are not your companies, are run by some other. Now in that, if you are a group CFO, you have to ensure in your consolidated accounts, all these elements are going to be reflected. If you are doing a group auditing, your auditors will come and say, look here, I could not get this investment balance, associate balance from that company, they are not giving me the details, right. So likewise there can be, now in my example I said 10 companies. Imagine if you are a CFO of a company that has 100 subsidiaries, associates and so on, right, then consolidation process may be very complex, right. So this is the topic, group. Now I am not talking about group auditing, because there is no auditing without financial reporting. So let us say we are our topic is group financial reporting. Please write it down, because I am going to, without this understanding you will forget theories, right. Group financial reporting. Now I use the same analogy, same explanation that I covered in the previous similar, right. Now what you are auditing in financial statements, there are 3 things, right. No, 4 things. You will have transaction, account balances and disclosures. Now this is, let us say, your parent company P, this is a parent company. Now as we say it is a parent company, now like I said, this company has subsidiary 1, this is a subsidiary. I am taking only one, right, as example, because we can have a situation of 5 subsidiaries, right. Let us take 2 subsidiaries for a reason, right. This subsidiary, as you know, traditionally, if you ask from a traditional accountant who is not up to date in terms of accounting standard, how do we consolidate? The answer may be, if there is a voting right, more than 50% you consolidate, this is 55%, this is, let us say, 40%. So I am asking, can we disregard, this is not a subsidiary, right, and these 2 are subsidiaries. At the same time, this company has another company. Okay, I think I will use a name for this so that it looks interesting, right? Yeah, you can have parent name, say the parent is Nature PLC. This company is Nature PLC, and in the Nature PLC, this company is Sun Limited, and this is Moon Limited, right? And then you can also see as now let us talk about business as well. Nature PLC is in the business of, so as the name suggests, nature, right? They are more into, let us say, property business, and now they are looking to diversify. So, they want to diversify as well. So, this company, let us say Sun Limited is the company which is mainly into real estate, buying lands and keeping those land, real estate, and this company especially they are doing construction. So, real estate, now they have recently started this apartment building as well. So, real construction, right? And then to fund these businesses, they thought of investing about 30% shares in another company. Let us say this is Star Company. And now, as you know, if your investment is less than 50%, 30%, you may say this as associate. Why I say may say, I will explain to you technically, can this be associates or not, right? I think this is cell case 30. So, we will cover the relevant, I will talk in a little while in terms of technical standard, right. So, this company is a finance company, right. And then, so they decided, they want money for the purpose of property business, and therefore, this associates has come to light. And then I am saying this is 1, 2, 3, and I am saying another scenario this year. Now, this was there as at 31st. Yeah, this was the situation as at 31st March 2019, right. Then by 31st March, 31st December 2019, right, they decide to invest. Now, I said they want to diversify. They invest in a hotel chain. And this hotel chain, there are two companies. Okay, these hotels operates in India and Maldives, right. This is hotel chain. And let us say this investment is exactly 50%, and investment is done. So, I want you to remember this investment is done by two parties, right. 50% by Nature PLC, balance 50% by another company called Max Limited. So, with Max Limited and you have formed another company, and this investment was done during the year, right. And at the same time they decided, same period they acquired, let us say this is also happened 31st December, that is a significant month, 2019, acquired a supermarket chain. Now, let us put this in financial reporting language, right. I want to introduce some key parties, right. Now, these subsidiaries, company's auditor. Now, we use this word. So, remember the language is very important. If I am supposed to explain to you group auditing, there is a language, the terminology to be used. The auditor of company, parent company's auditor, right. So, I will say here the parent company's auditor is called principal auditor. For us, one important, please write this word, right, principal auditor, right. So, let us say principal auditor is what? Pereira and Company. Pereira and Company. So, all this I say PC, Pereira and Company Audit Sun Limited, Pereira and Company Audit Moon Limited, and here this is another audit firm. Let us say this is Fernando and Company. So, Fernando is another audit firm, and obviously this is in India, this is another audit firm. This name is Sena and Company, India audit firm, right, and supermarket chain is audited by Victor and Company. Now there are several audit firms, right, Victor and Company, Sena and so on, but remember what matters is Pereira and Company. Why? The principle, first learning point, if you are given a group audit opinion, the party who should take responsibility ultimately is the principal auditor, Pereira and Company. All other auditors, we have a name, please write that name, they are called what auditors? They are called component auditors, right, component auditors. Now I put a streak marks against all of these names, component auditor, principal auditor, right. And now this is from auditor's perspective, right. I also want you to learn company's perspective, that is there are names, okay, I said you are a group CFO, right. So, who you are, right. So, there is, let us say now the process, now you have been given the task to prepare consolidated financial statement. So, I here write consolidated financial statement. That is really challenging. Prepare, consolidate. Now, you can see the entire thing has to be consolidated. There are many standards that matters. I use the red pen in a little while to see how many standards can connect and how do you apply them, how things can go wrong, right, consolidated financial statements. And therefore, you, let us say you are someone, group CFO, right. So, you become a part of group management. So, I want you to write this word group management. When you are group management, any company which is a part of your company, right, your group directly coming under your group. So, especially these two companies, this is under your group. So, all others we call component management, right, group management, and you can say component management. When I say that you learn another, you already know this word component auditor, like that the management of these companies we can say component management, right. So, now I am using a red pen to explain to you, one day, right, you become someone as a CFO, or let us say you are not someone, you are the accountant under someone, right, you are Mahesh, you are supposed to prepare consolidated financial statements. So, what are the dynamics? Now, imagine you have an Excel sheet that these columns, right, all these columns are there, and this column I put a streak mark. Now, what are these columns, right? Okay, this is a parent company, right, this is subsidiary 1, right, that is in my example Sun Limited, and this is Moon Limited, right, and then we will see the supermarket company is here, and there is another magical column, and there are big numbers in this column. What is the magical column in consolidated sheet? Console adjustments. So, I write here adjustments, right. Now, there is from for example, as you know, this company, construction company, what happens is, in the real estate, all the construction is done by this company, right. The construction is done by this company, which means there are significant sales and cost of sales adjustment from this. When it comes to consolidation, you are line by line adding figures to arrive at consolidated number. Remember, one of the golden rule in consolidation is you have to eliminate RPT. So now I am telling you, when you prepare consolidated financial statements, see all the red color ones, different accounting standard come to the picture. LKS 24, related party transaction, you have to identify related party transaction and eliminate related party transaction. Now I have to find out is there sales between sun and moon and eliminate. Now if you are auditor, how can you audit all these adjustments? And it's not only related party transaction, sale that I should eliminate. Now what is the margin? I write this is one elimination of transaction, right, 1.1, 1.2, you have to eliminate margin, right. Say subsidiary, irrespective of your percentage, you will eliminate margin in full, right. So those are consolidated adjustments. What is the standard? LKS 24. So I am on one principle of consolidation, which is called, in simple understanding, if I want to add line by line add and get the number, say this plus this plus this plus equal consolidated revenue, I cannot add without eliminating related party. Rule number 2, I cannot add if there are gap differences. So all this comes under one standard, right. What is that golden standard for consolidation, right? That is SLFRS 10. It's very powerful standard, right. I will explain to you in a little while. SLFRS 10, right, the standard which is applicable for consolidation. What is gap? Generally accepted accounting principle, right, generally accepted. If there are accounting principle, now if you want to add consolidation line by line, right, now you want to add revenue recognition policy of subsidiary 1 is different from subsidiary 2, or inventory valuation. If you take now, if you want to add all these companies together in one line, one of the principle is accounting policy should be the same. Accounting policy should be the same. Now if you look at, I'll give you a very good example here, right. This company in India and Maldives, they don't follow SLFRS. In India, there are Indian accounting standards. Some Indian standards are still different from IFRSs, right. And in Maldives, I am sure they are not fully aligned, right. Now you may find that some of these countries use accounting standard which are different from you. For example, let us say in India, they are not fully accounting for, earlier there was a requirement like that, they account for derivatives when there is a loss. Now here, whether there is a profit or loss, we account, right. So likewise, for example, say earlier Indian standards, I don't know now whether it has changed, right. Now the things like capitalization of borrowing costs, those are not allowed. Now when there are such difference, you can't consolidate. So adjustments to be made for accounting policy differences. So please note this down, accounting policy differences, right. Another challenge that you will come across, time adjustment. Time adjustment to be made. What do you mean by time adjustment, right? Now this main company's year end is 31st March, right, but you will find another company, the supermarket year end is December. So you have to ensure all are consolidated using same time. So the other obvious thing is, in Sri Lanka our currency is LKR, right, but when it comes to India and Maldives, the India currency is INR, right, and Maldives they have MR, Maldivian rupees. Now can you add figures in 3 currencies? No, you have to take all currencies to common platform. That's another accounting standard, right. So then now I have no space here, I am writing, you write with me. This another adjustment is where you take all currency into one platform, that we call presentation currency. For the purpose of presenting, we take all to LKR, presentation currency. Now again, this is accounting standard LKS 21. You have to identify functional currency versus presentation currency. Note this word if you don't know. Functional currency means the currency which relates to primary economic environment in which the company operates. So in this case, if it is a Sri Lankan company, the functional currency, I use the word functional currency. These are very important technical words in financial accounting, right? Functional, so I didn't write it properly, functional currency, LKR. But in India, functional currency is INR. When it comes to consolidation, we take all into LKR, that is called what? We convert all this currency into one, especially INR and Maldivian rupee using closing rate method. What is the closing exchange rate? And then differences are counted in other comprehensive income as because it's not a usual transaction and is predominantly unrealized. Remember that currency adjustment is a big adjustment, right? Okay, if I repeat it again, when there are multi currencies, take all currency to presentation currency. Currency translation has to happen using closing rate method. Now these are some of the dynamics. Remember, it's not over. Now this company was acquired during the year. You apply another SLFRS to ensure it is accounted, and that SLFRS is SLFRS 3. What is SLFRS 3? Business combination. Now when you acquire during the year, in your balance sheet there will be asset, right? Say you will record in the balance sheet asset called goodwill, because you are going to pay. So what is goodwill? Right, now this company, now goodwill is the difference between purchase consideration, how much you pay, 100 million you pay, right? At the date of acquisition, what is the fair value? So I highlight this word fair value of the assets and assumed liabilities. Why we use the word assumed liabilities, right? Now for the purpose of this, usually we take actual liability, right? Now even there is a likely contingency you may value in this calculation, right? Now the goodwill calculation at the time of purchasing, say 100 million, and then if you take fair value of asset and minus assumed liabilities, this value to be say 80 million. So you are paying 20 million excess the goodwill, and when goodwill come to balance sheet, remember there is always inherent risk. Why? Every year goodwill has to be tested for impairment, right? So now what is the issue here? When it comes to group auditing, one of the risks you will write, this is acquired during the year. Whenever there is a fair value in auditing, you can always write an answer. Why? Estimating or ascertaining fair value involves subjective assumption and judgment, therefore misstated. As a result, goodwill may be wrong. And second answer is goodwill has to be tested for impairment. Impairment is a complex process. All these are answers in exam question, right? Now if you ask what are the inherent risk in group account, what are the balances, definitely you will write one balance is goodwill. For this reason, because goodwill is a complex calculation. And there are more adjustments I am not explaining to you. For example, purchase consideration, if this is going to be contingent, that is called contingent consideration, and if you pay this in installment, you have to discount. All these are different adjustments, right? What is the standard that I covered? SLFRS 3. Now let's get into the bigger standard. The bigger standard that really matters in consolidation is SLFRS 10. Why? Because I told you, you might say here you have the control. What is the keyword in SLFRS 10? Control. Control has three elements, which I will show you in a little while, right? But I am asking you, here there is no 50%, 55, this is 40, is there a control? Can this parent Nature PLC, can they control Moon Limited because they have only 40% of shares, right? Remember, there are three things under modern definition of control. One is, although you have 40%, we can prove three things. One is, this company has the power, right? I use the word power, and they are exposed to variable return. I use the word E. What is E? Exposure right for variable return. I hope you are writing in your sheet. Exposure to variable return. Now what is variable return, right? If I am investing in this company, when their profit changes, I am going to get that part of the variable share. If they are making losses, I am exposed to variable return, right? And then I have the ability to use. Now this is power. Power alone is useless. Yeah, you have a power, you are exposed, and are you able to use the power? Connection, connect these two. What is connection? I am using my power, right, to change the profit. Now that is called consolidation. I am sure this is, you only understood theoretical. Let's put this practically. Now this company is in construction business, right? There is, you have 40%, let's say there is another man who has 60% shares. For the simplicity, right? Let's say there are another two men, say one man is 30 and the other man is 30. Now these two are also significant shareholders, but who has the control? If you look at the party with 40%, although he has only 40% of power, he can use this power, right? Now you see, using the power, right? See, I haven't now those students who are, you have to be really with me to read this word. Now this is power, this is exposure. Exposure to what? Variable return. Now this is connection. Can I use the power to change the profit? Let's say you can decide, right? Now in a company, this is a construction company. Although with 40% share, sorry, your shareholding is, I said 40%. Although with 40% shareholding, you are telling board of directors, you know, you have to purchase material from this supplier, right? You have to sell only to us. Now, which means relevant activities of the business. I use the word relevant activity here. Relevant activities. If you can use the power to influence the relevant activities and change the profit, although with 40% you are controlling, that is a very big point to audit. Now if there is a company, they say no, this is less than 40%, we have not audited, we have not consolidated, you are challenging, look at the definition of control. There is a power, right, and there is a exposure to variable return, and you can use the power, right, you can use the power to change the profit. Why? You can influence the relevant activity. That is SLFRS 10. So therefore, if you are auditing, you have to evaluate sometimes with a subsidiary to be consolidated. The next question equally applies to significant associates. So I actually indirectly told you when it comes to associate, here the keyword is control, here the keyword is, LKS 27, keyword is significant influence. Significant influence. Now these words are very nice, no, you can write down significant influence, but what does it practically means, right? If now this definition is very broad, there are three things, right? Now I am sure most of the students don't really understand these things in much detail, right? Power, exposure, connection, there is all this can be nicely presented in my PowerPoint in a little while, but understand this terminology. Now this is an introductory slide where I teach you the language, the words that you have to use in group accounting and group auditing. So now what is significant influence? SI. So we learn the control word, it has three things, you will see in the slides very clearly these three with the definition, and it is there in your book as well, study text. And when it comes to associates, we say significant influence. What is that? Ability to influence finance and operating decision. For example, right, one board member, right, one of the board member of parent company, they sit in this finance company's board and participate in decision making, which means you significantly influence. But if you are not in the board and you don't make any influence, even with 30%, it will not be associates. Remember that. The other thing that matters, see, they are going to acquire, I am using the same example, right, they are going to acquire a company. Now I see you, follow carefully your learning point, right. Here I explained to you SLFRS 10, right. Now here I explained to you significant influence LKS 27, associates, right. Now here this is a joint venture, right. Now you know there is a separate standard. Now what is this scenario, right. Now this word joint control, if I write the word joint control in terms of SLFRS 11, what does it mean? Now there is a hotel, right? Nature PLC has 50%, Max Limited has 50%. Now, who can control the relevant activities of this hotel, right? Whether we are going to renovate the hotel, change the management, if all this decision requires, remember this word, unanimous consent. If any decision relating to relevant activities requires unanimous consent. So, I am writing that word, unanimous consent. Consent means ekangataavaya, unanimous, right? Both parties should agree mutually, unanimous consent. Now, you want to refurbish the hotel, the other party says, no, we can't do that. You can't do that without my consent, right? So, if both, now say without unanimous consent, if one party has power, it will go to control. If one party has power to influence. So, this is where joint control applied. So, what is the word you are learning here? Joint control. What is the key word? Unanimous consent in relation to decision making that affect the relevant activities. Now, that is SLFRS 11. And there is another standard called SLFRS 12, which tells you, remember in the audit you are also auditing disclosure, right? SLFRS 12 is mostly relevant for the disclosures, because it is now, especially we are living in an era where there are transfer pricing, tax havens, frauds, shell company. Remember, when it comes to auditing, the biggest issue in auditing is, if you look at some of the collapses globally like Enron, the biggest issue, and even recently in Japan, one of the company called Olympus, the biggest issue was they created dummy companies, which we call shell company, and then they transferred all the loss-making unusual assets to the shell companies and avoided the consolidation. In Enron, if you look at there were hundreds of shell companies, and they ensured that some of these high-risk entities are not consolidated. That is why the SLFRS 10 or IFRS 10 was revised to address that issue, because new definition is very powerful. You can't just hide a shell company. If shell company is really there, right, for the purpose of these three, power, exposure, connection, if you prove that, it has to be consolidated, right. So, likewise, I explained to you joint control. Now, this is the point I want to say about SLFRS 12. This requires companies to disclose that they have these entities in different countries and so on, right. Now, see how many standards we have connected in this, and what is missing now. Now, this is about preparation of consolidation, right. So, now, let us look at this diagram more from audit perspective, right. Then I may have to erase some of the stuff, and I am converting this to auditing now. This is about preparation of accounts. So, what are the standards that mattered? If I am summarizing, right, make sure your note is completed now, right. Now, what are the standards we talked about? SLFRS 24 to ensure related party eliminations, margin, and the rule in SLFRS 10, line by line consolidation is possible when the accounting policies are same, the accounting period is same, and then if you want to consolidate, you have to ensure this definition, which has three elements: the power, exposure, and ability to use the power to influence, right, connection. Without these three, it is not a subsidiary. And then the significant influence to be associates, and to be a joint venture, the joint control with unanimous consent, right. And this point I explained to you, business combination standard, where at the date of acquisition we have to establish fair value of the asset. Now, all these complications I have explained to you. Let us look at this more from auditing perspective now. Right. So, I think there is very little to erase. So, I may use same diagram, right, to convert it to auditing. Question to you, right, before we go through the auditing standard. If you are auditing this group which has these subsidiaries, and you may conclude this is associates, you may conclude this is a joint venture, and one thing I forgot to tell you, right, if it is associate or joint venture, how it is going to be reflected in your consolidation? I am showing an arrow now to balance sheet of the consolidated balance sheet, right. Let us say this column is the consolidated column, console, right, balance sheet, and you are having this investment, right, this one, and you are also having this as an investment. It is not line by line addition, right. If you have 30% investment, let us say your original investment is 100 million and the post acquisition share is 30 million. You know, post acquisition share means out of the post, I am explaining it in a very simple way, right. You have 30%, right, yes, so that 30%, 130. Now what is this? This method of accounting is called equity accounting. Remember, if it is associates or a joint venture, right, where you prove joint control, the accepted accounting is called joint equity accounting. So this is equity accounting. So my question to you, question number 1, you can even write this question down. What are the areas group auditor should audit? Now if you are a group auditor, remember group auditor's name, I put down auditor's name also, Pereira and Company. Now Pereira and Company's partner is wondering now, this is dangerous, right. He is having a sleepless night after signing the audit report because he did very limited work about this hotel chain in India and Maldives, because those auditors did not cooperate to him. They did not give even accounts and no idea, but he has signed the group audit report. Dangerous. Therefore, in group auditing standard, please write number 1. Acceptance. If you are a group auditor Pereira, don't accept the audit if you can't access all these subsidiaries and they will support you. Please note that point. I am telling you, read group audit section of your study text today. In auditing, one of the main complex topic is group auditing. That's why I am taking little more time. So read today. What is the first point? In this is auditing standard number 600. Sri Lanka auditing, now I am converting from accounting to auditing. This is Sri Lanka auditing standard 600, group auditing. Number 1, right, the first point, don't accept if others don't support. Number 2, right, what is your purpose when you audit? You have 2 purposes. If you are auditing, right, number 1, you have to ensure, remember now in the console, if I tell you now this table, right, it's a horrible table, but I am sure if you were with me, you knew what I wrote and every little thing as I write, I explain to you. Now this table, right, is your consolidated, this column is consolidated column, this column is separate, company has a separate column, and this is a magical column, adjustment column, this is a parent company column. Now by looking at this circle, I am telling you, you have 2 things to audit, and if you are a brilliant student, you should answer my question. What are the 2 things you audit? Yeah, number 1, audit all this company if it is relevant. I said relevant, why we will discuss. You have to gather audit evidence, that's a better word. Gather audit evidence about individual financial statements of component. So remember that word, right? One purpose is gather audit evidence about individual financial statement. I am going to show you several case studies after this example so that you will understand everything properly. So number 1, you audit individual entities. I am asking, is it enough? No. Why it is not enough? Because you have to audit another one, because this consolidation column comes with this magical column. Therefore, the second thing that you will audit is the consolidation process. Consolidation process, right, consolidation process. So when it comes to auditing, I said 2 things, one is individual financial statements, other thing is consolidation process. So those are the 2 things that group auditor will audit. So my third question to you, let me to put those questions back. What is number 1? Accepting group audit. What is number 2? What are you going to audit? 2 things. What are the 2? Individual financial statement and consolidation adjustment. My third question to you, right, what is your approach to audit? So there has to be audit approach. Now that is an interesting question. Why? If you are Pereira and Company audit firm, I said you are auditing only subsidiary 1 and 2. The balance is audited by Fernando and Company, Victor and Company and Sena and Company, and they are in different countries. So, your audit approach is for the purpose of statutory audit, anyway you are auditing, you are doing a full audit of this company, right, but this you do not know whether this is properly audited, you do not know whether Victor and company has done a good audit, you are not sure. So, therefore, remember, right, this terminology before the auditor, right. Now, I also mentioned someone, group CFO. Group CFO will ensure that everybody in this group will follow uniform accounting policies, year end is the same and accounts do not have material misstatement. Therefore, right, please write this down. Someone issue instruction to all subsidiary. I am not drawing any more arrows so that it will be complicated. If I do so, someone issue group audit instruction, right, sorry, group reporting instruction. Group reporting instruction, because accounts are prepared. Now, do not misunderstand. If I ask you who prepared these accounts, is it company or the auditor, right? These accounts are prepared by the company. Before auditing, the financial reporting comes. Someone issue instruction to all components that you have to follow our policy. These are the parent accounting policies and this is our year end. These are some of the guidelines for disclosure, and he has given maybe Excel sheet or reporting pack. Please make sure the numbers are included in this format. Now, that is what someone will issue, and most probably Pereira and Company, where is Pereira and Company, the auditor, right? This auditor of the parent company will use the same audit instruction, that is called similar thing, right, group audit instruction, because group audit instruction, right. The reason is that this audit firm has no idea about other audit firms. Therefore, this auditor will tell that this is what I expect when it comes to auditing, right. I want you all to focus on these high level things in this company, they have related parties. So, there is communication that happens. The group auditor will tell all others that you all have to audit especially these balances, and this is the materiality level. That is a very big point that I wanted to mention, right. Materiality level for group audit is another topic, right, materiality level for the group. So, I will cover that separately, but same principle is applied. If you take the consolidated profit, you will take 5% of that, that is the materiality level for the group, but for each component you will select a lower materiality level, that is called component materiality level. So, therefore, please write that word, another new word that you learn now, component materiality level. So, that is the level, using that level. For example, component materiality level for this company is 10 million. Let us say group materiality level is 50 million, right. So, 10 million is relevant when we audit this company. So, now the point that I was finally explaining to you, Pereira and Company will issue group audit instruction. It will cover areas of high risk, materiality level, most importantly deadline. This is a March client, we have to finish the audit by June. Therefore, you all have to give audited schedules to me at least by that date, because I have to give opinion for the management. So, therefore, all these auditors will report to, so I am not drawing any arrows, right. All these audit firms will report to whom? Pereira and Company. These are the schedules and these are the issues we found, and finally after evaluating everything, who gives the group opinion? That is Pereira and Company, right. So, if I ask you some fundamental question, number one, who is responsible for the final audit? Pereira and Company, therefore, he should not accept if he can't access. Number two, you are auditing two things. I said one, you will audit individual financial statement, right. Number two, what you will audit is this magical column, that is called your auditing consolidation process, right. So, number three, third question that I ask you, what is your audit approach, right. So, third question that I ask, what is your audit approach? Now, your approach depends on, now if you count how many entities here, how many components, 1, 2, I have already put number 2, 3, and then this is 4, and then 5, there are 5, right. And if I tell you the Pereira and company will decide, this is significant to me, this is significant to me. Therefore, I name that as significant component. That word is extremely important. Please write the word significant component. So, the most important concept you learn now is this, significant component. Significant component, right? But Pereira and company will say this is not significant, right? This is other component, do not say non-significant, say other component. So, my big question to you, right, how did you decide whether this is significant? Apply the same logic that we learn in materiality standard. A thing can be significant by size as well as risk. So, based on the size, this hotel may be significant, and based on the risk, this hotel may be significant. Now, when we say size, the idea is do not apply that 5% of profit, that is wrong. That is not the size. This size refers to, please write, if I write IFS, what does it mean? Individual financial significance. And if I put here revenue, out of consolidated revenue, this company contributes 30%. Is that significant? Yes. Out of the total asset of consolidated, this company contributes 10%. Is 10% significant? I will say no. But how did I say no? By looking at 10%, how did I say 30% important? Again, I can give you the auditor's logical answer, professional judgment, but student as a guide, you know, even it is mentioned in study text, in one of study text as well as one of the para, right, you can use a threshold, right, of say 15% of asset, revenue or profit or anything. If it goes through that threshold, you will decide it as a significant by size. Remember, although by size it is not significant, it can be significant by risk. Now, one of these entity in India, you see, let us say this supermarket, right. Now, this supermarket, there is a significant litigation by the government, they are going to stop the operation, and this is a significant risk. By size, this is not significant. Why? This company is only 5% of revenue of the consolidated revenue, only 10% of the consolidated assets. So, it is not significant by size, but there is a litigation, therefore, it is significant. So, auditor will choose saying this is significant, this is not significant, right. And if it is significant, remember, auditor has to ensure this is audited. Now, you will wonder, what do you mean by audited? This is anyway audited by Sena and company. No, the idea is Pereira and company should get the comfort that all the important items are audited. So, therefore, they have to go through the full details of Sena and company. But when it comes to this supermarket chain, let us say there is no litigation, no risk, is not material, then you are not doing audit. You will only analyze and see whether there are unusual fluctuations. You do only analytical procedures, right, for other components. So, remember, this is my explanation 1. In my explanation 2, all these sub areas will be again presented to you so that you understand. So, the point for you is, if it is significant component, it is audited. If it is other component, you are only analyzing. Please write other component, analytical procedures, right. So, if you miss that point, do not worry, in my next explanation you will catch that, because I want to give you a big picture at one. This is one of the most complex auditing topic in auditing, advanced auditing, and one of the most complex auditing standard, because it talks with lot of accounting standards, right, connects. So, now this what I am explaining to you, right. In your audit approach, you audit in 2 things. One is component. All the component we put into 2 baskets, significant component, other component. The second element to audit is this magical column, consolidation process. Now, I am asking you as a company, as an auditor, auditing in few days, how do you audit whether all related party transactions are eliminated, margin is eliminated, adjustments are made, equity accounting is correct? How do you ensure? And every number in this column, for example, that say this Indian hotel company, every figure which is taken to, this is an Excel sheet, end of the day, this is a spreadsheet or some system, every figure in this column should agree with company's original accounts. But my big question to you, if you are an auditor, do you think that you will detect all this misstatement? Answer is probably no. That is why if you are an auditor, your first choice before substantive procedure is to rely on control. So therefore you are learning another new thing now. When it comes to specially consolidation process, the group auditor is interested to audit what control, these controls are called. So if here my consolidated accounts, if I put a circle here, what protect consolidated financial statement is, remember, group wide control. Group wide control. Now if you know internal control, can you give me an example of a group wide control which ensure console number is correct? The best example is every month the here CFO send a confirmation to all subsidiaries and ask, our balance is 5 million, tell me your balance. Intercompany confirmation and reconciliation is done every month to ensure these transactions are eliminated. And the audit committee review adjustments, internal auditor check consolidated adjustments. If all this is there, you are happy about the consolidation process. Therefore, you will test these controls and you will adjust your substantive procedure where you will audit the consolidated individual financial statements as well as consolidation process. So this is the bigger story that I explained to you in this analysis, right? Now I am going to go through example case studies. I am sure at this stage, if I ask you to what level did you understand what is on the whiteboard now, I would say you would have understood about 60%. Balance 40% you wouldn't have understood. That is why in my next explanation I am going to most complex areas and explaining to you, for example here, significant, non-significant, significant and other, how did you decide? And that I will explain. Third thing, I will also go through, because you can't read some of these words, no, carefully some of these terms that we learn. Third thing we will do, we will answer some case studies. So we will now go to those sections. I am going to take you through the slides so that you will carefully follow what we learn. Now, see, this is a very important slide, because before auditing we need to understand how accounting standards are applicable, and I am sure this explanation is useful not only for your auditing paper. If you are doing financial reporting, you can see the connection between auditing and accounting. So in the consolidated accounts, one of the questions we should ask, control alone or jointly. So SLFRS 10 we discuss if you control alone with those three criteria, which I will show you in the next slide. Then if you do a joint control, the standard which is applicable is SLFRS 11, and that joint control, this standard name is joint arrangement, SLFRS 11. This slide is an international slide, but you can read, you can only change the word SLFRS, right? This slide is from IASB, International Accounting Standard Board, one of their presentation. So joint arrangement, there are two types as you see. One is a joint venture, that is what is more applicable for us, because when you say joint venture, you have the joint control over the net asset. I will show you this in another slide. And joint operation is, you know, two parties are doing a business, they don't necessarily have control, therefore it will not be accounted using equity method. Joint venture is equity method, right? So if it is a joint operation, only asset liability may be accounted. So when it comes to significant influence, we have IAS 28, and if there is no significant influence, remember that becomes a normal investment. So, this is an important slide, and what is not in this slide is IFRS 3, which SLFRS 3. So, then this is the most interesting slide. If you want to control a company, I said there are 3 variables. Do you have power? Your power is useless if you cannot use the power, right, to change this profit. So, 3 things: you have a power and you are exposed to variable return, meaning when that company's profit or loss, right, and it can be even other line item in the accounts like commission income or royalty, right, which is changing, not fixed. Then changing means you are exposed to risk, no, right, and can you use power to change the profit? If you satisfy all this, now read this carefully, right, exposed, so has the right, that is one. Variable return, right, that is another one, and then ability to affect the return through the power. So, this I explained to you. Now, what I explained to you, now I am breaking down. So, accordingly, under power, if you break that further down, so under power you should have right to control the relevant activities. Exposure is the exposure to variable return and the link. So, joint control I again explained to you, contractually agreed sharing of control, the unanimous consent, you know. If you want to make a decision, both parties' consent is required. Then few minutes before I told you, if it is a joint venture, the key thing is when parties have right for the net asset, then it is a joint venture. This slide SLFRS 11, see, equity accounting is applicable when there is a company where you have the control over net assets, joint control, right. So, the key word is here net asset. So, then it is equity accounting. If you do not have that, is only asset liability you can account. So, this is SLFRS 11. So, what is very important, this slide is extremely important. You can just read it out. I will leave it with you for you to read. Control means what? You can highlight this expose, right, or has the right to variable return and has the ability to affect those return through power. So, power means this is also important. What is power? Actually, that is voting right. Remember, it is existing right that give the current ability now to direct the relevant activity. Relevant activity means relevant business activity. Significant influence means power to participate in financial and operating policy decision. But be a practical student, what does this means in practice? See, one board member from parent company can sit and vote and that kind of a thing. As audit evidence you should be able to see. That is the auditing part of this. Otherwise, you will see this is accounting that you are learning. No, how are you going to audit this? See, board minutes you will read. And similarly, you should look at whether there is a joint control. Then, this slide is critical because all what I explained to you in my previous analysis is captured in this slide. If you are a group auditor, what are your objectives? Number one, whether to act. Do I, now Pereira and company, they are thinking, should I do this audit because I have no access to Indian auditor? Number two, if you are doing, please write to them saying that this is the scope and you have to come back to me with this. And third one, you have to gather evidence on 2 things. One is financial statements of component, right. The other one is consolidation process. These are the 2 things that you will audit. And therefore, remember, if you recall that in auditing, always risk assessment matters. In auditing, there are 2 things, right, RAP and FAP. RAP means risk assessment process. For you to do a risk assessment process, you need to understand, right, understand. And you even, okay, what this side of the slide covers is requirements. Now, this is the objective. Every auditing standard has these 2 objective and requirements, right. If it is a group audit, number 1, overall responsibility should be taken by what is this GEP, group engagement partner, for overall audit strategy and the plan. So, now this word is very important, right. Now, I told you RAP, risk assessment procedure, is about when you understand these 4 areas. I have not put those 4 yet. Then you are in a better position to assess the risk. So, what are the areas of understanding in a group audit? Now, you should be able to tell me, right. Now, for example, in a group also you are auditing, in auditing what are we going to check? Whether there are risk of misstatement, right. Now, if you want to know risk of misstatement in a group audit, it is not one entity, right. My early example, property company, if they have investment property, one risk is fair valuation of investment property. In a hotel company, the another risk is impairment of hotel. If you look at nowadays, impairment is a big risk for hotel because no tourists during the lockdown period, right. So, therefore, number one thing that you will understand, what is this group, what is the structure, right, ownership and how many components, what industry they are. So, remember all this is not written in the slide, right. If you now, that is why I said today you have to read this chapter and do a case study, then that is done, put a tick mark. I am ready for group auditing. Now, we discuss pilot paper, even in the pilot paper there is no question in group auditing, but the examiner can certainly test if examiner wants a small case study in group auditing, right, which is very easy if you understand. At the end I will tell you what are the possible examinable topics. So, you have to understand the group and components. Second thing I covered you, how do you know related parties are eliminated, margin is eliminated, gap adjustments are done, that is summons. In my example, summon of the group CFO, he is issuing instruction and ensure that group policies are adhered to. These are called group accounting policies. Group wide controls. One of the control that I can tell you, in some companies they use software for consolidation, then that IT control ensure the information is accurate, that is also group wide control. Third one, you have to understand consolidation process, how it is done. Is it done manually in Excel sheet by a person who is not qualified? Then risk is high. When you audit consolidation process, I will give you some tips what to look at. The last thing that you have to understand is the component auditor. There are about 4 things you have to understand. Please write this down, right. Now, you have to make your own notes here, but after these notes, if you can read study pack, within very limited period, maybe 1 hour, because you know all the concepts. The component auditors, in my example, Indian audit firm Sena and Company, right, Maldivian audit firm Victor and Company, right. Now, these auditors you have to check at least 4 things, right. One is whether they are competent and they have the relevant expertise and they are independent, and you should be able to access to those auditors and they should cooperate, right. And finally, you should look at that country also, like Sri Lanka, the institute as well as Sri Lanka monitoring board, they check auditors. There is a regulatory environment. So, that type of environment, is it there in those 2 countries, India and Maldives. So, you are checking the audit as well. So, after this understanding, right, you will identify, actually it is not in this diagram, I will probably draw another new diagram to show how this connects. Now, before this response, you will identify, if I write here 2 things, you will now decide 2 things. One is group level audit risks like fair valuation of investment properties, impairment of hotel. Second thing, you will identify these 2. What are the significant component? What are the other component? If there is a significant component, you have to audit. If it is other component, you will do analytical review. This is a very high level picture. Now, let us get into a case study. This is again, I have taken case study from study text, so that it is easier for you to refer, easy for you to read the study text, and after that I have given you my own case study that I have developed, so that you will cover that part, right. So, let us see this question quickly. I am giving you time to read this down without disturbing you, you can quickly take a look. So, one of the thing you see in the first paragraph, this group name, right, Salto, 540 million is the revenue. Majority of revenue, now they have given a percentage, 70% is generated by this parent company, right. 8% is generated by fixed, and I told you if it is 8%, is it significant? Usually no, unless there is a risk, right. So this was purchased 10 years before. So this is not a significant component. If the question is to identify significant, because 8% does not reflect what I said, individual financial significance. Later they have diversified and now they have invested 100% in an insurance company called Lento, right, and it contributes 20% is significant or not. I gave you a threshold of 15% as a guide. So this is significant by size. There is also a sentence to say that this company is making losses including impairment. Now that is a risk as well. Now there is an impairment charge which is 23%. So therefore this is definitely significant both by size as well as by risk. Then later this company completed purchase of shareholding of another company called Giro, right, a competitor, but this competitor is only having 2% of shares, 2% of revenue from the console. This is not significant. Now you know the answer as well, right, it's very easy. Now this is very important slide. Again from study pack you can go to audit planning slide, chapter 4.5.1, and this is a very important explanation. If you miss my diagram, these are the words which are highlighted, right. Significant component means individual financial significance. The second one is significant because it has a significant risk. Remember I explained to you in my lesson 1 when I did audit planning. What is significant risk? Significant risk, those risks which are significant by auditor's judgment because it requires special audit attention, that is significant, right. So in this previous example, insurance company impairment requires special attention. Then this is a exam purpose, this is very useful for you. Use this 15% guide. If a company has more than 15% of maybe revenue, profit, asset of the consolidated relevant items, say consolidated revenue or profit, that company is going to be a significant component by size. Even though 15% criteria is not met, by risk it can be significant. Now this is very, very important. So I want you to go back to previous case study and use a blank paper now, right, and draw this, you draw the, like I drew group on the top, then you can put 3 arrows, one company, you can put the percentage, right, one company 70% Salto, then another company, right, 100% that is Lento, another arrow that is 100% Giro. Out of these 3 entities, this is not significant. Therefore, we are going to analyze accounts so that we see whether there is any unusual fluctuation. That is called, if it is other component, if I go back to my previous slide, what are we going to do? Analytical review. For example, you compare their line items with the parent companies, put all the columns together in detail line level and see there is unusual other receivable charge, and you may want to question that. By analytical procedure means your analysis of financial statements, right. Now what the correct word is? Evaluation of financial statement by looking at plausible relationship. You will see their sale and GP margin is very different to the group, right, very different to the last year. Then you may want to question. So therefore, as far as I ask you to draw this, right, as far as fixed is concerned, you will put your audit approach is analytical review. Then Lento, what are you going to do? Lento you will consider as a significant component, right. There you will decide, you have any of this option, right. This they also have impairment charge. Now these are the options available to you. If it is significant component, again this is from your study pack. One is you can make sure that full audit is done using component materiality level, right. Component level I explained to you, used to audit that particular component, and it is usually given by group auditor, right. Full audit. If you want, because you see one of the risks they have identified is impairment, right. If I go back to the slide, because this is anyway significant by size, let us assume that this 20% is 10%, so that it is not significant by size, but still it is significant by impairment charge. Therefore, you will select the second option where you will audit only impairment, or you will do specific audit testing to audit impairment. That is where step 2 and 3 is relevant. So these are the steps which is relevant to significant component, and I have covered that. So, case study 2, which is a case I have developed for you, multi-star group. Please write case study 2. This is a case where you will do more application of that and see. You are the senior manager in charge of the multi-star, large conglomerate and diversified business, and they go by merger and acquisitions. The group reported a profit before tax of 10 billion for 2020, right, and the asset is 150 billion, and they have 5 subsidiaries, right, and the figures have been given to you, and these are the names: Builder Company Construction, Builder Construction, Superstar Hotel, and these two are audited by trust company, leading audit firms, right, and then all other subsidiaries are audited by different local audit firms. You are not the you are the auditor, right. Now, if I put these numbers, this table is very important for you to judge. See, in the exam, one of the likely question if group auditing tested is this: decide which components are significant, right. So, now if you look at by this, profit figure is given 3 billion. See, out of 10 billion, 3 billion is material, right, 0.2 billion not material, right. So, like that profit figure you can see, and asset figure, asset value is what? The asset value is 150. You can see whether these are material. See, material is the wrong word. What is the correct word? Significant component. Then I have given a note, matters of significance. See, not identified. Insurance company, this is recently acquired, and insurance board has issued a warning. Now, you see in Sri Lanka there is IBSL, Insurance Board of Sri Lanka. They ensure that insurance company has enough margin. So, that is a test, solvency margin, and auditor has to give a report on solvency margin. Now, there is a problem in solvency margin, means insurance company may not operate and it may affect going concern. That is a very serious matter. Although this is not significant by size, you may decide this is significant by risk. Superstar Hotel, there are 5 hotel constructed, all construction works are undertaken by builder, which means there are related party which we have to eliminate, right. Anyway, this is significant by size as well as related party is a risk. There is a pharmaceutical company, they have large stocks of expired stocks. Now, this is definitely a risk. Imagine when there are expired stocks in pharmaceutical company, what are the assertions at risk? Inventory valuation, there can be the liabilities coming from litigations and so on. Then supermarket not identified. Now, see, this table tells you in the exam, if you want to analyze this, what I have done, I put this as columns, and I put, you know, what is given in the case study is profit and tax. This is the group number, and I put this has to be a percentage, right. Sorry, these numbers I put, and then I put the percentage. Then you can see 32 is material by size, because our threshold is 15%, if you remember. 2% is not significant, 40% is significant. These are not significant, but I mark these two as significant. Why? Insurance board has issued a warning, therefore you want to audit solvency in particular, and maybe the entire company, because solvency is, you know, not a one-off matter. Solvency is not one balance, right. Then in pharmaceutical company also you may want to audit specific one. But so now therefore I will mark all these 4 as significant, and this one is not significant, therefore I will do what? Analytical procedures, right, to see whether there is anything unusual. So, I think that comes to the session break, but I want to make sure that I am covering one more matter, which of course some of you will think whether I explained to you properly. When you audit, I think I will put this last thing in a diagram, and I will conclude this session, so that you will see the big picture as a summary again. And yes, so I will do that now, then we are done with the session 1, and that is my summary analysis. And you can see up to now today, this is what we have learned. This is our first break. I mean, session break means, you know, major areas that we covered. So, you learn materiality, overall materiality, planning, all of that, group financial reporting process, group audit approach, and you can see our next topic to come is audit reporting, which is your chapter 16. But before that, let me to put this summary, so that you understand very clearly. If you have missed out anything, the group reporting dynamics. Right. I think you are familiar to this analysis, this type of conceptualization which I did in my first 2 sessions. Let me to put that down first. Right. So, this will tell you, how, because I use similar type of conceptualization for many standards in this session series for you to easily understand the connection step by step conceptually, and also I have done case studies so that you are familiar with. So, I will ask, in any risk based auditing I can use a similar analogy, right, similar conceptualization. So, the first thing in an audit process, RAP and FAP, I will start from this and it will feed to this, and then we should be able to see the end result here. So, end result we should be able to see here. Right. So, the first thing in an audit is to perform risk assessment procedures. That is where you will understand something, and from the understanding you are able to identify risk and assess risk. Actually, in particular you are assessing risk. So, these are the 2 big things in group audit that will matter, and accordingly in this you will have, say, I am now in this case I am saying this is auditor's response, right. In terms of response, how do we respond? So, what risk assessment procedure means? Okay, first of all if you have forgotten this, I will ask, what are the 4 things that you have to understand in the context of group auditing? Number 1, if it is a larger group of company, you need to understand the entire group structure. If there is an auditor who is going to audit a company without asking management, please give me group structure, then you are like a blind auditor. You will later see these companies deliberately hiding 5 companies which are overseas companies in tax haven, and they have avoided consolidation. You will miss that. So, you should ask, in some companies this is a very secret document, right, because there are there are a lot of Sri Lankan companies even. I am saying it's genuine. You can do business for tax purpose. You can have subsidiaries, tax shell companies, like special purpose entities in different countries, right. So, you have to understand this group structure, and then what are the group and what are the components. This is one. So, in my example you remember how we discussed this. Then secondly, to ensure that the consolidation process work properly, you have to see, do they have group wide controls like monthly reporting of group accounts, audit committee reviews it, the console accounts are captured in a ERP system, and then intercompany transaction reconciliation, all of that. The third one you have to ask how consolidation numbers are prepared, right, that is the consolidation process, right, the year end use, how they do the gap adjustments and who is doing this and so on. Then the fourth part you have to understand is the component auditor, and I told you about component auditor. What are the four things that you have to understand, right, whether this auditor is capable, the competence, whether this auditor's ethics, independence, things like that, and whether this auditor is regulated by like chartered institute or monitoring board, and can you access to this auditor. If you want to understand all these dynamics in a larger group, what are the components, what do they do and so on, we can write general auditing, right. General auditing requires you to do inquiry, right, and inspection of documents, and you can do analytical procedures. But if you customize this understanding to a group auditing scenario, right, I will write in this side what are the specific things that you can read, the specific documents that matter, especially group audit instruction is important document that you can go through, right. This is something very relevant to group auditing, group audit instruction, how management prepare consolidated financial controls, right. So, especially when you do your inquiries, you will talk to group management, component management, right, and get idea about this. And then after you understand when it comes to risk assessment stage, having understood various groups, you will see these are the risk of material misstatement at a group level in the consolidated accounts, and I am asking you, compared to another account set in a consolidated accounts, you will identify this type of risk. For example, goodwill impairment, because they have acquired a new subsidiary this year, right, and contingent consideration, because that is also accounted in the accounts likewise. So, goodwill impairment. And what are the any other new, say for example, you have a doubt about currency translation, you may want to take this as a risk to audit, specific risk, and significant related party transaction. These are specific risk in a group audit context. I recommend you, I am sure you are supposed to read auditing standard, right, that is all these notes are based on auditing standard. Go to 600 standard, there is a separate annexure in the standards called risk in a group audit environment. So, especially these are some of them. The other your identification is what? Significant component, right. So, you will your response to significant component, what are we going to do? Your approach, so you will with this understanding you will identify significant component and other component, right. And remember, in this risk you will also identify risk. Obviously, currency translation, related party refers, these are part of consolidation process. So, when it comes to response, let us divide this into few areas, right. One is, say if you mark like this is your significant component. If it is a significant component, you have three things you can audit. Now, when I say you can audit, remember this audit is done by another audit firm, you have to ensure proper audit is done based on component maturity level, right. If it is significant by size, this is mostly applicable. If it is significant by risk, you will audit, right, specific balances, and then if it is significant by risk, again you will audit specific risk, audit the significant risk. This is significant risk, right. Then in addition, in your response there are other components, right. Let us say this is other component. For other component, what are we going to do? Analytical procedure at group level. AP refers to analytical procedure at group level. And finally, what is our response to consolidation process? Now, this is a very important thing I want to touch when doing this diagram. In particular, how do you audit consolidation process? If somebody asks, I am sure study pack also has detailed note. See, there is exam question that identify 5 audit procedures to cover consolidation process. I would suggest the first thing is test of control, right. You can say test group wide control, right. Do not just write that, give at least one example like intercompany reconciliation, whether console numbers are coming from a ERP system. But other than that, when you audit, these bullet points are very important. Ask from the company, right, group structure, review the group structure approved by the board. That structure shows 10 companies, but in the Excel which is given for the consolidation, 1 company is not there. You will question. You have to review the group structure to ensure all components which meet the definition of control, right, joint control or significant influence, right, or yeah, those are captured. All components are counted. Number 2, you will ensure that you remember those columns, right, in Excel. This is the column of, in my previous example, right, this is the column of moon company, sun company. Now this is in one Excel book, let us say. Now whether these numbers are accurate, right, financial, now I write that as F5. What is F5? Financial information in console reporting. When I say console reporting, imagine this is an Excel workbook, that individual columns accuracy, financial information in console reporting is accurate, you will cross check, right, and then all other points that I am going to write here relates to those high risk areas. You will ensure that gap adjustment, generally accepted accounting policy, gap adjustments are done for any differences in accounting policies, right. And you will also check whether adjustments have been done in respect of differences in the accounting period, right. And then you will write another step, check whether currency, if there are foreign currencies, whether currency has been translated using the closing rate properly, right. Then you will write further, check whether related party transactions are eliminated together with margin. So all this audit testing connects to consolidation process. So that is the summary of that. I think with that I have given you a fair coverage of group wide auditing, and we are meeting in our next session, which is going to be a very important session, that is the audit reporting and conclusion.